Bom dia, pessoal. Bom, o painel vai ser em inglês, então para quem precisar de tradução simultânea, usem o headset. Howard, it's a great pleasure and honor to have you here again with us. Last year we hosted you online, right? So it's much better to see you in person here in Brazil. For those who don't know, Howard is the co-founder and co-chair of OAKTREE CAPITAL. OAKTREE is one of the largest investment firms on alternative investments, and he's also the author of some best-selling books in finance, right? Including The Most Important Thing, which was also a bestseller here in Brazil. And also, Howard is very famous for the memos you write, right? And they are the first priority of reading for many, right? Including Mr. Warren Buffett, right? When they hit our inbox. And talking about your memos, Howard, the most recent memo you wrote, I think was just last week, which was called I Beg to Defer. You talked about the need for us to turn against the crowds if we want to achieve superior returns, right? But in the current juncture, it seems to me that if you want to go against the crowd, probably the contrarian investor would have to be optimistic right now, because the sentiment indicators and people turned so bearish on the outlook. So is that true? Do you think the contrarian investor would be positive on markets right now?
Well, let me make clear, first of all, thank you for having me here, Fernando and Jenny, and for interviewing me today. And it's great to be in Sao Paulo in person. I want to make clear that while it's important to diverge from the crowd when it's right, it's not necessarily the right thing to do all the time. Only when the crowd is making a big mistake. At the present time, there are negatives on the horizon, both inflation, possibility of recession, higher interest rates, but also the global politics of Ukraine, China, and so forth. So while people are pessimistic, I don't think they're overly pessimistic. And I find that most securities that I deal with are priced in a reasonable range. So I think it would be a mistake to turn optimistic and highly aggressive at this time. I believe that each of us should calibrate our balance between being aggressive and being defensive. Everything we do, our portfolios should embody some of each, some aggressiveness and some defensiveness. And I believe that we should be in our normal range today in terms of that balance, not unusually aggressive and not unusually defensive.
Perfect, thank you. I wanted to ask a second question around macro. You wrote several times that you don't believe in macro forecasting or trying to type markets, as you described in your last few memos, like I Beg to Differ, and also thinking about macro. And you said that you approach macro forecasts with a very high level of skepticism. This year, 2022, has been all about macro and geopolitics driving asset prices. So I wanted you to explain to our audience, what exactly do you mean by that?
Well, that's a great question, Jenny. I went to a lunch. I'm writing my next memo now, so I'll give you a hint. And I went to a lunch, and it's a lunch for investment guys like me and gals. And the host led off by saying, well, in the last 2 years since we saw each other, we've had to deal with all these unusual things: the pandemic, the Fed rescue, Ukraine, etc., and the surprising success of the Fed, and now the emergence of inflation. So this has been a tough period for forecasting. Hopefully the future will be better for forecasting. My reaction is different. My reaction is to say, isn't that enough to prove to you that we can't predict the future? There are always things that come as a surprise. If I sit here and try to predict the course of the economy or the markets over the next year, isn't it for sure that some things will happen in the next year, significant things that I can't consider today? So, I've always been leery of forecasts. One of my heroes, John Kenneth Galbraith, once said, we have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important, if we don't know something, to acknowledge it to ourselves so that we can work around it. Oaktree's investment process is never dependent on macro forecasts. We have opinions. I have opinions on what's going to happen. But the thing is that I consider our opinions imperfect, so we don't bet heavily on our opinions, and I think that's right. And the last thing I'll say to you, you mentioned Warren Buffett. We can all think of very famous investors. Who are the investors who got famous for making macro forecasts? Who are the ones who were successful as macro forecasters? And I think you'll have trouble coming up with names. So Oaktree, rather than being a strategic investor, which is top down and says, what will the economy do? What will the markets do? What will the groups do? What will the industries do? We're bottom up. Which companies and securities are the cheapest today, without concern for macro forecasts and industry preferences?
Great. I mean, if we can't see the future, at least we can prepare, right? And one of the biggest harms for investors this year has been inflation, right? You talked about inflation last year a lot, and we saw that investors got really decimated on their portfolios. The 60-40 portfolios did pretty poorly this year. So my question to you, Howard, is how do you see the current inflation environment, and how can investors protect themselves from it, from a high inflation scenario?
Well, number one, Fernando, I just got finished telling you that I don't believe in forecasts, including my own. Having said that, my attitude toward inflation is fairly benign. I think a lot of the inflation we're having is related to the pandemic. On the one hand, the governments of the world gave out a lot of money, including giving money to people who were not hurt by the pandemic. So those people were actually richer than usual. And they couldn't spend it because in 2020 you couldn't go on a trip, and you couldn't have a wedding, and you couldn't do many things. At the same time, the global supply mechanism was put into a deep freeze. The economy was shut down. And so when normal economic activity resumed in 2021, it was slow to get started again. One of the things that I always try to say to people is, how many parts are there in a Toyota car? And the answer is 30,000 parts. Wow. What if 2 of them are unavailable? They can't produce cars. So, we before the pandemic, we had this machine that was working so smoothly, producing all the goods that the world needed, that we didn't have inflation. Now the machine is not working as well. Some goods are in short supply. When you face short supply with strong demand, you get rising prices. That is the definition of inflation. I think some of these things will abate. Other things may not abate. For example, we had in the States in September, October, something we called the Great Resignation. 4 million people left the workforce, resigned their jobs. This means that at the present time we have more job openings than we have unemployed workers, which means that if you want to hire somebody, the negotiating power is in the hands of the worker. What do they want? Higher wages, inflation. So will that subside, or did the people who left the workforce do so permanently? No idea. We'll see. And by the way, since I don't know what the future holds, I say a lot, we'll see. And then lastly, inflationary expectations, inflationary psychology. Once people decide to adopt inflationary expectations, it gets embedded in their psychology, and it's very sticky. It's hard to get rid of it. I lived through the 70s when the US had double-digit inflation, and it was and it lasted about 8 years. It was hard to dispel. Of course, now we know more about inflation, and I think the government has more tools. But, you know, when people expect inflation, they say, I think prices will go up, so I'm going to buy now to get ahead of the price increases. What's the effect? It makes prices go up. So inflationary expectations are self-fulfilling, and I allow for the possibility that it will be a challenge to dispel those. So my answer to you is, inflation pre-pandemic was below 2% for a long time. Now it's 9%. Some of those things will abate, not all, some gradually, but I think that over a year from now we'll probably be looking at 4%, and you know, after that it may come down further. But let me stress before I leave this topic, the people who think inflation will be less than others and invest on that basis will make a lot of money if they're right. The people who think inflation will be more than others think and invest on that basis will make a lot of money if they're right. I don't know which one is right. So I'm not going to take a strong position, and I would urge your audience also not to take a strong position on things that are not knowable. And let me just say one last thing. I had dinner with Warren Buffett about 6 years ago, and he said to me that this is important. He said, for a piece of information to be desirable, it has to satisfy 2 criteria. It has to be important, and as you said, the macro is very important these days. The macro moves markets. But number 2 is that it has to be knowable. And I believe that the macro future is not knowable, so I don't consider it very desirable to work on it or to invest on that basis.
But how can we protect ourselves from an inflationary environment?
Obviously, how can we protect ourselves? Well, when we have inflation, we have rising interest rates. You can buy floating rate debt if it's priced fairly relative to fixed rate debt. Everything is but. You can buy, one of the things I did is I bought a bunch of apartments because landlords can raise rents in a period of inflation. Hopefully the workers are making more money and they can afford higher rents. That's an example. And then thirdly, and this is not the easy part, some companies can pass on cost increases, some companies cannot. Clearly, in an inflationary period, you want to be in the companies that can pass on the cost increases and not the others.
Perfect. I think those are some great points, especially about macro. And I wanted to talk about another thing that you mention a lot on your memos and your books is about second level thinking. You know, and one of the steps to reach that is asking yourself, you know, who doesn't know that yet? You say that a lot. So what is the second level thinker thinking right now, you know, that we have a discussion about an upcoming global recession?
Well, first let me explain to the audience what second level thinking is. And if you read my book, The Most Important Thing, which I'm very happy to say is out in Portuguese, the first chapter, by the way, there were 20 chapters, and each chapter says the most important thing is, and then it's a different thing. Because in investing, there's not one important thing. There are many things that you have to consider at the same time, and that's why it's difficult. But the first chapter says the most important thing is second level thinking. Most people think on a rather superficial level. They're not sophisticated, they don't think deeply, they don't know about the deep questions. Everybody's trying to make money. So clearly the money that will be made, the superior results, will go to people who think deeper, than the others at a higher level. And so the second level thinker thinks differently from the first level. The first level thinker may say, for example, it's a great company, we should buy the stock. But the second level thinker might say, it's a great company, but it's not as great as most people think. Their high opinion of the company has raised the price to a level which is undeserved. We should sell the stock. Now, clearly, the second level thinking is much more complicated and requires much more effort. But if you want to make money, isn't it reasonable to assume that it requires effort? And we should engage in that. So the point is, if you want to have superior investment results, now let me say, investment is a field where it's very easy to have average results. And there's nothing wrong with average results because over the years, investing has made people financially comfortable. You can get average results very easily. The question is, do you want above average results? Some people will settle for average, nothing wrong with that. Some people want above average, but if you want above average, clearly you have to do something different from the average investor. You have to think different, behave different, and of course your thinking has to, it's not sufficient that your thinking is different, it also has to be better. You have to be more right than the average person, which is not easy. Now, you said, what's second level today? I think it's second level today to believe that all is not hopeless and that inflation can be controlled. And you know, one of the things I say, and if you take anything away from today, I hope it will be this. Think about the real world in which you live, your day-to-day life. Things fluctuate in your day-to-day life between pretty good and not so hot, between okay and I wish it were better, like this. But investor psychology, once it gets rolling, fluctuates between flawless and hopeless. And when investors think that the outlook is flawless, they set prices which are too high, from which the probabilities are not good, and when they think the outlook is hopeless, they set prices too low, from which it's really easy to make a lot of money. So one thing I would recommend to you is to be on the lookout for times when most investors seem to be too optimistic or too pessimistic. Number two, of course, it's essential that you not fluctuate with them. And if you join the crowd that becomes too optimistic and pays too much, and that becomes too pessimistic and sells out too cheap, your results are going to be as bad as theirs, and certainly not above average. So it's important to look for these excessive swings of psychology and not participate in them. So I believe that at the end of 2021, investors were too optimistic. Things had gone surprisingly well with the pandemic. The vaccine arrived surprisingly fast. Businesses bounced back surprisingly fast. The stock market rose surprisingly. Everybody thought things are going to be great forever, and prices went too high. Then, when people began to be concerned with inflation and started to conclude that inflation was out of control, what they basically said, in my opinion, and by the way, you can't look any place to find these things out. You have to surmise these things from your experience. What I think people said is, well, we have inflation, and that's bad, and the Fed may raise rates to control the inflation, and that'll produce a recession, and that's bad. So in other words, it's all bad. And life is not all bad, and it's not all good. And so I believe that people became too negative on the outlook, and by mid-June, I was ready to turn aggressive because prices, I thought, were too low because psychology was too negative.
I think you touched on my next question that I'd like to touch, which is your views on the cycles, right? You're very well known. I just finished your most recent book on cycles, and you talk about the fact that markets tend to follow the business cycle and the economic cycles, right? So I wanted to ask your perspective on the current environment, because when we spoke last year, you told us exactly what you just said, which you thought, you know, it was an early cycle, but actually prices were already pricing a lot of optimism.
Yes, the Fed and the other central banks were very effective manipulators in the pandemic. They forced us to go into the markets, and they forced us to spend our cash. And our forced buying caused the markets to rise. Exactly how, it's complicated. I'm not going to go into that. But so what we said, certainly in 2020, was the market got ahead of the reality. And over the course of 21, the reality caught up to some extent. But then this year, the reality has weakened, and prices have gone from too optimistic to, I think, essentially reasonable. I think that the excessive optimism is gone from the market. Lots of people are pessimistic. And the excesses in terms of security prices have pretty much been weeded out. And when I speak, I often get the question, where are the excesses in the market today? And I don't find any. I don't find anything that's ridiculously high. I'm not saying everything's cheap, but no crazy highs. So I think that in terms of the cycle, you know, the economy has turned down in terms of GDP production in the United States, and may turn down further as the Fed raises interest rates. So we're going to go through a slow cycle, and we're going to probably go through a slow market. But in investing, there's always the question, okay, there are negatives on the horizon. Have they been anticipated by security prices? The S&P reached a high of about 4,900. And then in late June, it reached a low of 3,700. So the S&P went down 25% from the high to the low. And it's not enough to say, are bad things happening or do bad things lie ahead? You must also say, okay, some bad things are going to happen, like we're probably going to have a recession within the next 2 years. Is it anticipated in stock prices? The fact that we have a recession ahead doesn't mean the market's going to go down if the market prices already anticipate that recession. Hard to know. There's no place you can look. You know, if you Google, do security prices anticipate the recession, you can't get an answer or a valid answer. But these are the judgments that we have to make. Since I'm among so many good friends, I want to give everybody a present. When you talk about the market cycle, 50 years ago, when I was a kid in this business, somebody gave me a present, and I'm going to pass it on to you. It's discussed in the market cycle book, but you might like to hear it today. So the gift that this person gave me, what he called the 3 stages of a bull market. And what he said to me was that in the first stage of the bull market, maybe there's been a crisis, maybe there's been a crash or a bear market, and security prices have come down and everybody's very pessimistic. In the first stage of the bull market, only a small number of unusually insightful people realize that there could ever be improvement. In the second stage, most people accept that improvement is taking place. And in the third stage, everybody assumes that things can only get better forever. So you have to understand the difference of the environment in the 3 stages and say, which one are we in? If you buy in the first stage, when very few people are optimistic, that's when you get the great bargains. If you buy in the third stage, when everybody's optimistic and thinks things can only get better, there's a lot of optimism built into security prices, some of which will not turn out to be true. That's when you lose a lot of money. So it's as extremely important to realize what kind of environment we're in. And I personally think, Fernando, that we're in a moderate environment. I think that nobody thinks things are going to get worse forever, but nobody thinks things are going to get better forever. And so Oaktree, at least, which does not try to time markets and invest on the basis of forecasts, is behaving normally, and we're always somewhat defensive in our portfolios, and that's the way we are today. I will just say that our asset classes are risk asset classes. We don't buy gilt-edged stocks. We don't buy treasury bonds. Ours are risk markets, and we always think it's appropriate to incorporate a good, healthy level of defense in your approach to risk markets.
Perfect. Thank you for that answer. And then talking a lot about cycles, specifically in your latest book, Mastering the Market Cycle, you described the cycle as a pendulum, right? But the pendulum, it does have movements that are predictable, right? It goes to the one side and to the other side. And I agree that markets do go up and go down all the time. But can you maybe describe, how does markets resemble a pendulum, and what are the characteristics that it doesn't resemble a pendulum?
In the book, we talk about cycles. Cycles look like this. In the chapter on investor psychology, I talk about pendulums. A pendulum looks like this. What is this? It's this turned on its side. It's really the same thing. People say to me, especially engineers, say to me, oh, that's not a pendulum. A pendulum is predictable. It always moves at the same speed and in the same arc. That's a pendulum. Well, if you look in the dictionary, you'll find both definitions. A pendulum can be something which dependably moves from side to side at a known speed, or it can be something that fluctuates. I'm using the latter definition. So nobody should think that the pendulum of psychology is dependable or predictable. Sometimes it changes fast, sometimes it changes slow. If you know what's one thing interesting to look at, why did the market go down from January to June? And the answer is inflation. Investors became very concerned about inflation. When did inflation begin to appear in the United States? April of 21. They ignored it from April until December, and then they went crazy over it in January to June. And that's what I try to describe as the pendulum. It is not dependable or regular or systematic, but it fluctuates like crazy. Over the course of my career, when I was working on Mastering the Market Cycle book, I said to my son, I think my market calls have been about right. And he said something brilliant to me, as he usually does. He says, Dad, that's because you did it 5 times in 50 years. 5 times in my 50 years, the market was so crazy high that you could tell it was time to get out, or so crazy low that you could tell it was time to get in. In between, we're not so smart. And when the market is 5% overvalued, or 10% undervalued, or 15% overvalued, it's not clear what one should do. And that's why I believe in not being a market timer and keeping your eye on the long ball, which is an intelligently constructed portfolio of good securities that you can hold for the long term.
And as a follow-up to that, we saw during the first half of this year that financial assets had a massive correction, right? When you look, everything fell from bonds to stocks and cryptocurrencies. It's probably one of the largest value destructions we've seen in modern history, right, in terms of dollars. And a lot of people were describing the environment we were in as the bubble of all things, right? We saw the most expensive art, most expensive watches, most expensive cars, everything, real estate as well, prices going up through the roof. Do you agree that we were in a bubble environment before, and do you think those excesses are now largely corrected?
I try to avoid words like bubble because they have no agreed upon meaning. But what I would say, Fernando, is that everything was expensive. Everything that you named and other things had gone up very strongly, you know, in the last few years, but in the 12 years or 10 years from the global financial crisis in '09 to the months just before the pandemic in '19, everything went up very strongly. But there's a reason for that, and it may not have affected the watches and the paintings, etc. But over this period, the Fed and other central banks reduced interest rates and kept them low. And through a mechanism which I won't go into detail on, which we call discounting, declining interest rates make assets worth more. And so, you know, I had a loan outstanding from a bank in 1981, and I have a slip on the wall of my office which says the rate on your loan is now 22.25 from 1981. In 2020, I was able to borrow money at 2%. So interest rates fell by 20%, or what we call 2,000 basis points. A basis point is a hundredth of a percent. And that had a very, very powerful effect on the valuation of all assets: bonds, stocks, companies, apartments, and maybe also watches and paintings and cars. And you know, if I want to sell you a Ferrari, and I say this car is going to cost you $200,000, when the interest rate is 14%, you say, just a minute, if I take $200,000 out of my investments, that's going to cost me $28,000 a year. That's too much to pay for a Ferrari. But if the interest rate is 2%, you say, if I take $200,000 out of my investments, I only lose $4,000 of income. That's cheap. I'll take the Ferrari. So interest rates have a profound effect, and the low and declining interest rates, the lowest in history, by the way, in many regards, made all assets very valuable in the period just before the pandemic, and were in large part responsible for their recovery now. But now what do we know? Now we know that the Fed is raising interest rates, which in turn reduces the value of assets, and that's a good part of why the market has cooled off.
Thank you. Perfect. And I wanted to switch gears a little bit and contextualize this conversation to our audience. Here in Brazil, we recently surpassed 5 million investors in the equity market in the beginning of this year. We still have a very long way to go to be comparable to the US, for example, but that was a very important mark for us. Many investors nowadays, including many of them who are listening to us right now, they're new and they are experiencing, you know, this current downturn for the first time in their investing lives, or investing experiences. So they're not really familiar with the market's ups and downs that we're seeing right now. So what is your advice for these people who are just starting to invest?
The great thing about investing is that an economy has a positive underlying trend. Economies tend to grow over time. Because of economic growth, companies tend to increase their profits over time. And of course, we can go out and look for companies that will increase their profits at an above average rate. We try to do that. But the beauty of investing is to harness the long-term trend. The S&P 500 in the States has risen about 10% a year for the last 100 years on average. And if you invested at 100 years ago $1, believe it or not, and if you could avoid transaction costs and avoid taxes, which we can't, but if you put in $100 100 years ago and left it there, you'd have about $8,000 today. That's the beauty of investing. That's what we call long-term compounding. And investors should get on that and stay on it, and not screw it up by getting in and out and in and out and in and out. And I think that's very important. as you know, in my last memo, I said that if you wait at a bus stop long enough, eventually you'll catch a bus. But if you run from bus stop to bus stop, you may never catch a bus. Now, the hyperactive investor who does not share my wariness of forecasts says, I'm going to go to that bus stop and get a bus, then I'm going to run to that stop and get a bus, that stop and get a bus, that stop and bus. But these things are not predictable, and if you run around, you may fail overall. So for every investor should have a baseline foundational component of their portfolio that gets on that compounding trend and stays with it. In the long run, Brazil is going to grow faster than the United States. I believe it has such great resources that it has enormous potential. So you want to get on that trend and stay with it. With some of your money, it's okay to try to do a little better, to anticipate what will do well, to get out of markets when they seem too high, to get back in and turn aggressive when they seem to be too low. And some people can do that, but not everybody. And some people will enhance their results by trying what I call trick shots, and some people will learn that they're not capable of doing it. But there's nothing wrong with trying, as long as you have that bulk of your portfolio invested for the long term and undisturbed. And I really think that that's one of the most important lessons. And importantly, I'm not here to try to convince you that investing is easy. What I would much rather do is convince you that it's really hard. And so you should be modest in your expectations. You should be modest in your belief of your own capabilities. And you shouldn't try to get in, get out, change your portfolio so that you're always right. Because if you try that and you mess up, you could be always wrong.
Talking about being better than the market, right, and doing a little bit better, I wanted to ask you to talk about OAKTREE to our audience, and how do you strive to achieve superior long-term returns, and how do you differentiate from other active managers?
Well, we're not an equity manager, but you know, I started to manage money in '78. I left the equity research business and became a money manager, and I was lucky. I started off in convertible bonds, which was a tiny little niche that nobody knew about, and then in '78 I was asked to start a high yield bond portfolio at Citibank, which I think was the first one from a mainstream financial institution. And now I was investing in things that most people didn't know about, understand, or feel good about. Most people were worried about it. Most people thought high yield bonds were unsavory, speculative instruments. And because they wouldn't invest in them, that made them bargain priced for me. And I did it, and it was very successful. People were afraid of the risk of default on these bonds, so they required the bonds to include a high risk premium, extra yield. It turned out that they have overestimated the risk, so that the risk premium they required was excessive. And I did better than I should have, given the risk. And that was a lesson to me, and my whole career and what OAKTREE does emphasizes things that other people don't know about, or don't know about as well as we do, or can't study as well, and things that they're not into. And you know, imagine two piles of securities or stocks. On this pile, we have the things that everybody knows about, understands, and feels good about, and the things that most people think have a bright future. On this pile, we have the things that people don't know about, don't understand, don't feel good about, and think have a poor future. Which pile is more likely to contain the bargains? Just think about that. That one, right? So, you know, in telling my own story, I should have started at the beginning. I joined Citibank in the investment research department in 1969. And the bank was an investor in what they called the Nifty 50 in the 60s. These were the 50 best companies in America, that the fastest growing companies, companies that everybody thought they were so great that nothing bad could ever happen, and so great that there was no such thing as an excessive price. And if you bought those stocks the day I started work in September 69, and you held them firmly for 5 years, you lost almost all your money in the best companies in America because they were too popular and they were overpriced. And then, as I said, I shifted to the bond department, and I'm working with these obscure securities that nobody knows about, feels good about, or is optimistic about. And now I'm making money easily and safely. And there's a lesson in that. For me, the lesson is that successful investing doesn't come from buying good things, it comes from buying things well. And you have to understand the difference. A very high quality asset can be overpriced and make a really bad investment, like the Nifty 50 in 1969, and a low quality asset can be underpriced and be a great investment. So that's why we've been investing in high yield bonds since 1978. These are bonds that have non-investment grade ratings. They're considered speculative. In 1988, we progressed into an area called distressed debt, and our distressed debt fund was the first distressed debt fund from a mainstream financial institution. Now we're buying the debt of companies that are in default or bankrupt and expected to be. And people would say to me, how can you buy the debt of companies that are not going to pay their debts? That's the definition of a bankrupt company. The answer is that if you own debt and you're not repaid as you're supposed to be, you get a claim on the value of the company. And if you have bought that claim at the right price based on knowledge and analysis, you can make a lot of money. And our distressed debt funds have been very successful in the last 34 years since they were formed. In 98, I went into people's offices and I said, I'm here to offer the 4 worst words in the world. Emerging market hedge fund. We just had the ruble crisis, the Southeast Asian crisis, long-term capital had melted down and people lost all their money. And nobody wanted to hear it, but that was the place to go because people rejected it and the securities were cheap. So Oaktree tries to be, I mentioned the fact that we're not macro forecasters, we're not market timers, we try to be opportunistic, bottom-up investors where we spend our time looking for the greatest bargains, and historically it has worked.
And do you like the high yield market now? Because last year the high yield market wasn't really high yield, right? We saw very low yields, but now we see them back on the 8-9%.
Yeah. Last year, high yield bonds yielded 3%, and so they were low yield bonds. And the only real benefit they offered was that 3% was dependable. Bonds are much more dependable than stocks. Today, as Fernando says, high yield bonds yield closer to 8. And now you have a substantial yield. Now, when I started in 78, they yielded 12. And I've seen them in the crises of 90, 91, 01, 02, when they yielded 20. So 8 is a lot better than 3. It's still not high. It may or may not go higher than this, but I think the important thing about high yield bonds at 8 is that that's what I would call a useful return. 3% is not a useful return. It's not going to permit you to buy my Ferrari or do many of the other things you want to do. 8% is a living wage, and so I think that they can reasonably be bought here.
Perfect. I think we are reaching the end of our conversation. Yes, I do have one closing question. What career advice would you give to someone who's starting in this investment world right now? And also, would it be different, would this advice be different if it was maybe 10, 15 years ago?
Starting in the investment business or starting as an investor?
As an investor, I would say.
Well, you know, the world gets smarter over time. Knowledge is cumulative. We all know a lot more than we did 50 years ago, if we were alive 50 years ago, and we have access to great amounts of information on our phones. Warren Buffett talks about having been able to buy dollars for 50 cents in the past. And I can tell you that in the 70s and the 80s, I was able to buy things that made no sense. They were stupid in the sense of how underpriced they are. Now, everybody has more information. We're all wired. We have our phones. Everybody has data feeds. Everybody has the ability to apply programs and apps and screen universes. And so nobody should expect to be able to buy dollars for 50 cents in an intelligent world. We use the term in the profession, we use the term an efficient market. And the market has become much more efficient over time, which means that prices have tended to converge with value. Now, from time to time, the world has a fit, and it either gets too optimistic and things go too high or too low. And I wouldn't argue that up here the price is fair or down there the price is fair, but on average, prices are closer to values than they used to be. So everybody should accept, certainly in developed world markets like ours, that it's harder to beat the market than it used to be, and the margin of superiority is reduced. I think it's still worth trying, but it should be done on the basis of study, an understanding of how money is made, and a lot of hard work. But, you know, for me, I've spent 53 years in this business, and it's fascinating because it's always different. There's a good book, I don't think it's available in Portuguese, called Fooled by Randomness. And the writer, Nassim Nicholas Taleb, really talks about the role, or the predominance of randomness, luck, in investing. A lot happens that nobody could predict. And he talks about, he always compares investing to dentistry. And he says, if you go to dental school and you learn how to fill a cavity, and you fill the cavity that way every time, you'll be successful every time. Believe me, there's nothing you can do as an investor that will make you successful every time. So if you want to be successful every time, become a dentist. But if you can live with being wrong 40% of the time, you can encounter great intellectual challenges and hopefully rewarding success as an investor.
Amazing. I think now we're at the end of our conversation. Howard, thank you so much for coming down here to have this conversation with us. I'm sure the audience also enjoyed it a lot. Pessoal, uma salva de palmas.
I just want to, thank you. I just want to say that I was down here in May of 2018, and that's when I met XP. And I was so impressed by the mechanism for bringing competent, decent products to investors. And I was so impressed by the large numbers of accounts opening every week and every month that, you know, we've been partnering with XP ever since, and we're very happy to have done so. And this is my first expert. Very glad to be here, and I hope it won't be the last. Thank you all for being here.
Thank you so much,
Thank
Howard.
you. Obrigada, pessoal.